All right. Hello, everybody, and welcome back to another episode of the Wealth Building for Dummies podcast. I am dummy number one, Kyle Demian, and we've got dummy number two, Renji Matthew here. And today we're going to break down and talk about taxes, how tax brackets work, how to save for your future, whether it's tax deferred or tax free, and then kind of what we expect taxes to look like 10, 20, 30 plus years from now, and how it can help you be in a position to optimize, ideally paying the least amount of taxes over the course of your lifetime. So today we're going to jump in and talk about that. And Renji, to get us started, I'm going to go ahead and start sharing my screen, and let's kind of break down and start to talk about how taxes work. And let me see. Should be sharing now for you. Can you see that okay on your end?
Yeah. Oh, let me make it.
Awesome. So let's break down first the tax brackets and kind of how they work. Do you want to take us through this chart?
Yeah. If you're they look at if you're single, filing single. If you're married, finding or married, you can file separate or jointly. And then they also look at head of household. So let's say you're making 20,000 a year. If you're making 20,000 a year, you're probably going to be in the 12% tax bracket. If you're single. If
Yeah.
you are married and filing jointly, then you're going to be in the 10% tax bracket. They give you a better tax break if you're married and all that stuff, especially if you're filing jointly and stuff like that. So let's say you do make 20,000 and you're single. You're going to be at that 12% tax bracket. That means out of that 20,000, you're paying 12%, which is what is that? 2,200.
We don't need to do the math. I'm not
Yeah,
good at math on the spot. Don't
just,
worry about doing the math.
just over 2,000. So
Yeah.
that means you're paying just over 2,000 in taxes. And that's just the simple thing. That's not counting retirement stuff or anything like that. Do you want to take that part, Kyle?
Yeah, for sure. And just focusing on that, I think it's important to note here that on the first 11,000, let's just focus on single filers just to keep it simplified. But yeah, on the first $11,000 that you make, you're taxed 10% on that 11,000. On the next, 36,000 or so between this bracket up to the $47,000 a year range, you're taxed 12% on that bracket of money. And then if you're making over 47,000, let's say you're making, 75, you're going to be taxed 22% on all of the money above and beyond your $47,000 a year income here. So that's kind of how that's called a marginal tax bracket, and that's how it breaks down and how it works. Now, speaking of taxes and kind of just breaking them down, this is obviously how taxes work for today in 2024, based on your income of what you make today, right? And a couple of ways to save you on taxes now. If you have any kids are a tax deduction every year. If you have a mortgage, your mortgage is a tax deduction. And then, of course, if you are contributing to any tax deferred retirement accounts, like your 401k, IRA, or something that's a qualified account, you do get a deduction on your taxes this year. You are purposely deferring taxes to the future, but you do get a deduction this year, and it may save you on some taxes, right? And as we start to talk about, building wealth, and this is the Wealth Building for Dummies show, we do want to talk about that and look at, what do we expect for taxes in the future? And in Renji, I'm going to share this chart, which you should see now, and kind of walk us through this chart, what it means and how it can have an impact on us as a generation that's saving for our future, and maybe
Yep.
why we shouldn't put too much money into tax deferred accounts. So break down this chart for us.
Yeah, so in this chart, it's showing us, back in the 40s, 50s, the taxes were up in the 90 percentile. Originally, when 401ks and IRAs were created, it was in the late 70s. So you could see in the 70s, that's the tax brackets in the 69 percentile. So it's lower than what it was right after World War II. And the reason taxes were so high right after the war is to replenish the economy. Taxes were so high to be able to replenish and everything like that. So um, the problem is, originally when the 401k and IRAs were created back then, it made sense because the whole point was, could you imagine paying 60 to 70% of your income to taxes? That's crazy. So the whole
Yeah.
point of the accounts was, hey, let's put most of our money into these accounts. That way, when the tax brackets comes down to 40s or less, now when we take out the money, we just pay a lot less in taxes compared to at that present time, right? So that's why these deferred accounts were made, and they're just tax codes. They're just tax codes to, because what most people don't realize, there's almost 8,000 pages in the tax code. And out of those, there's three buckets. One is tax now, which is like income, stock, stuff like that. Two is tax deferred, which is where 401ks, IRAs, and everything fall into. And the third one is the tax free. That's where Roth IRAs, TFRAs, and stuff like that fall into. Those are all tax codes. So if you know how to read the tax code and how to use it for your own benefit, there's so many ways to save money on taxes. And at that time, 401ks and IRAs made sense. But
Mhm.
like we just looked at, if you're at the 10% tax bracket now, where you're making 20 grand as a single person, if you defer taxes, you don't know what your tax bracket's going to be in the future. You want to take over from there, Kyle, and talk about that kind of what it would look like for people?
Yeah, for sure. And a good thing you mentioned there, I wrote down and wanted to touch on is like, yeah, there is 8,000 or so pages in the tax code. The average person avoids the tax code and they're almost like scared of the IRS. Where the wealthy, they know how to use and leverage the tax code to their benefit to pay the legal minimum every single year. That way they're keeping and investing more of their money rather than sending it to Uncle Sam. And that's proper tax planning. It's paying the legal minimum that you're required to based on the IRS tax code, right? And so, yeah, back to, looking at this and as far as like future retirement planning, future tax planning, here's the number one thing I'll say. If you're making, let's say that you are making $75,000 a year right now, with a good retirement plan, I think most people would expect or would want to retire with about $75,000 a year of income. They would want to make in retirement what they're making while they work. Most retirement planners, most financial advisors, they say that you can settle and live on less in retirement. We like to talk about building wealth and actually being able to thrive in retirement and have, if not at least the same amount of income as you were working when you go to retire, if not more, right? That would be the ideal scenario. You retire and have more income.
Mm-hmm.
So if that's your goal and you don't want to retire and make less money, you're going to end up being in like the same bracket here, right? You're going to be maybe in the same 47 to $100,000 range. And if taxes never change, you would still pay 22% a year in taxes in that bracket, right? But what if these tax rates go up? That's the part that we don't know. And I was reading an article from Tom Hegna that talked about the real problem with these 401ks and these IRAs is that you have no idea how much the government is going to take when you finally retire. With the incredible amount of government debt on the books, it's nearly guaranteed taxes will be much higher in the future. I think many people will be disappointed to see how little of their IRAs and their 401ks they will get. And we've talked about it before and kind of just actually diving in and talking about taxes, which is what this episode is for. If we come to here and we look at the US debt clock, um, there we go. So the US debt clock, this is a site that's always running 24/7. It shows how much national debt we are in as a country. And right now it's over $34 trillion and it's continuing to climb. Right? And Renji, how does the government pay down the debt that we're in?
By increasing taxes.
Increasing
Taxes,
taxes.
they pay it down. And you see that going up too.
Yeah. The government only currently collects about four trillion dollars a year in tax revenue. How do they pay down their national debt? They pay it down with tax revenue, but they only bring in 4 trillion, and we're at a deficit of 34 trillion. So, very simply enough, how do you overcome this deficit? You raise taxes. And that's what a lot of these experts, retirement planners, some certified financial planners are looking at, is saying, hey, this national debt number is way too high. They only collect $4 trillion a year in taxes. Taxes have to go up for us to overcome this deficit, right? And I made a post about this the other day, and somebody commented saying, yeah, or they could just limit their spending. And I don't know if there's ever been a president that's came in and limited the spending. Like, that's not going to happen. The government's going to probably only continue to increase their spending. But regardless, us as individuals, savers and investors, what we can do is we can control how much of our money is going to tax deferred, retirement accounts versus retirement accounts that grow tax free. And you don't have to worry what the future tax rates will be, right? You don't have to worry about what if they go up to 60 or 94% again, because all your money you would have paid taxes on and it's over and done with, right? So Renji, was there anything else that you wanted to add into on that topic?
Yeah, something that I ask most people is, do you want to pay tax on the seed or the harvest? It's something really important to think about when you're thinking about any type of retirement account or just retirement altogether. Because what I mean by that question is, if you're wanting to pay seed on the harvest, that's what a deferred account does. You're paying, doesn't matter if your account grew to 4 or 5 million, you have to always remember in the back of your head, part of that's not your money. The government's going to take their part. But if you paid tax on the seed, which is kind of like a Roth IRA or a TFRA or all of these money, you're paying tax up front for what the tax bracket is now. Yes, you might not have a big of a tax break, but you're not putting it off for later when you don't know what the tax bracket's going to be. Now, no matter
Yeah.
what it grows to, it's all your money. You don't have to worry about the government coming after part of your money anymore because you've already paid that tax up front. So there's so many accounts out there that you can pay taxes a lot earlier and you can grow it. You can let it, and you don't have to wait till 59 and a half to touch it. You can access it after a year. And this is what we
Yeah.
talk about, is using that kind of accounts. If you're wanting to have just a tax-free retirement, hey, these are better for you. If you're wanting to access passive income, these are even good for that, because you don't have to worry about letting your money sit in the bank account where it's not growing anything. You're putting it into something that's growing, and you still have access to it while you're finding out what you want to invest in. And at that point, once you figure out what you want to invest in, hey, now you have money that was growing tax free. Take it, go invest into whatever you want to. Now you're making money in both places. So there's so many different strategies out there that can save you from all the tax burdens that might come your way that people just don't know about.
Yeah, absolutely. And I'm a big visual learner, and this is one thing I wanted to say earlier, but you kind of went into it. Like when the 401k was created in the late 70s, they expected taxes to be lower in the future. So it
Mm-hmm.
made sense to defer your taxes, right? Defer them to the future. If we're in 1970, defer them to the future when we expect them to be lower. But nowadays, if everybody, almost everybody, is expecting them to be higher in the future, why would we defer them to some future point in time when they might be 50, 60, 70%? Right.
Yeah.
So this is exactly what we talk about and what we educate our clients on when we have one-to-one meetings is, hey, we don't know what the tax rates are going to be in the future. We do know what they are today. And they're some of the lowest tax rates that the United States country has ever seen as a whole. And so why not take a portion of that money and pay the taxes now? Get it over and done with, and that way you don't ever have to worry about it again. So that's something that you guys that are watching this want to have a conversation about, or maybe your advisor isn't talking about. That's what we're here to do, is to educate and obviously to help as well. And you can contact us on our social medias. We'll have them linked below here in the description. But yeah, Renji, is there anything else you want to leave us with today for our episode on taxes?
No, I think I would just add, because we've talked about passive income and how we like to harp on the passive income. If you do, let's say for for example, real estate, like we talk about many times, there's also more tax savings there because there's depreciation, there's cost of business that you could write off, all of these tax benefits that you don't have as an individual, that you're having to pay tax on all your income. And something that Kyle mentioned earlier too, Right now, you might have a mortgage. You might have dependents living with you that you're getting to write off. 95% of people, when they retire, they don't have a mortgage anymore, and they're empty nesters, no more kids living with
No
them and
little
stuff like
kids.
that. So what
Yeah,
they don't realize is, in the eyes of the IRS, hey, that's more taxable income. So forget the tax bracket. Now you have to worry about what the government's going to place as your taxes. And then on top of that, there's less things you could write off because you have less things to write off. So there's more money that's going to go out of your pocket. So it's just a few things to think about that people might not be thinking about.
absolutely. And that's the basis of strategic, financial planning and strategic tax planning. So I want to thank you guys for tuning in to another episode of the Wealth Building for Dummies podcast. My name is Kyle Demian. This was Renji Matthew. You can follow us on TikTok and our Instagram accounts, which we'll have linked below down here. And until next time, we'll see you guys on the next episode. Take care.
See ya.